you sent our team a series of charts about call volume, and I'm not exactly sure what I'm looking at. I think what it means is that the do-it-yourself or day traders are really ramping up activity, and what does that mean?
Well, it's not just the do-it-yourselfers. I did make a comment that the retail investor might get burned if they're not careful here. We do have retail investors going all in. You got to remember, we have a whole generation of investors that have never been through a bear market yet. They've been investing for the last 10 to 15 years, other than a quick snap down and a COVID drawdown. They've never really experienced a prolonged recession. We haven't had one in 15 years, or a severe bear market. And remember, the last two severe ones were over 50% down, the dot-com era and then the Great Recession of 08-09.
So we have a bunch of people lulled into a false sense of security.
Yeah, they don't believe that these things can happen. Yeah. And I'm here to tell you, I've been doing this for almost 3 decades, a long time. This can happen. I've been through 5 bear markets, et cetera, and it can get ugly. The other thing that's pushing these call volumes up is now the advent of levered ETFs. These are exchange-traded funds that use leverage. Now, we don't use leverage like that for our clients, but retail investors speculate.
Give us a definition of what you mean by leverage.
So they will use options to try and enhance the return. So, for instance, they're on a myriad of stocks. There's over 100 of them out there, but they're single stock ETFs. Like, you can buy an exchange-traded fund on NVIDIA, perhaps, one of the stocks that's been the best in class here the last 5 years, right? Amazing growth. But you could buy an ETF that gives you 2 times its performance in theory, but when it goes backwards, which it did, it went from $150 all the way down to $90, you lose 2 times as much money.
So the lever can work against you as well as for you.
And so there's so many people taking on leverage that they don't understand, at least in my humble opinion. When the dam breaks, it gets ugly. And so in that chart, when I sent the call, I sent a couple of just reference charts, and I'm not making any bold predictions, but the first chart was 2000, the dot-com era I just spoke of, where we had a 51% drawdown in the markets. Well, I put up another chart that just showed you the S&P relative 2025 to what we looked like in 2000. And when those wedges break, they break severely. And I'm not predicting it's going to break right now, but I'm just telling you, this is why we like to have some of our clients' assets with zero risk attached to them, principal protected things we can use. And depending what age it is, it would be different what vehicle we'd recommend. But everybody needs to understand how to properly risk allocate. From that 32-year-old questioner to the 72-year-old retiree, we can show you how to appropriately understand how to use risk mechanisms to protect you versus chasing the hot dot with extreme leverage, which unfortunately we're seeing more and more of. And the advent of Twitter and people out there doing that, they're promoting this like crazy. And the advent of gambling now, which is everywhere, sadly, this is the mindset of a whole generation. And they'll get burned at the gambling tables or on their apps betting on sports, and they'll do the same thing in the stock market because they do not understand true investing. Hey, if you're looking for more content like this, make sure you check out these videos, and don't forget to like, subscribe, and ring the bell so you'll be notified when we publish more content that will help you retire smart. Thanks for watching.